Hello and welcome. This is Professor Svark, and in this video I'm going to cover how to complete the Exam 3 practice problems posted on Blackboard. So hopefully you've had a chance to do this, and we'll walk through the solutions together. We're going to start with number 1, which is a bank reconciliation problem. And again, I recommend that you complete the bank recs that you know your bank rec format, which is the bank side and the book side. And remember, the bank side is plus deposits in transit minus outstanding checks and plus or minus any bank errors, which we don't need to know for this one, but it's just a good reminder. The book side is plus EFT collections minus NSF checks minus any bank charges and plus or minus any book or company errors. So if you know the bank reconciliation format, then we can just plug in, right? We're looking for the cash balance per book, so we're looking at the book side, and we can plug in these pieces. So the cash balance per books is $17,600. The deposits in transit are not needed for the book side. The note receivable collected by the books is $59.20, and that's a plus. $200 is, the bank charge for printing. $12,000 is outstanding checks. Again, that's the other side. And an NSF check is $11.20. And there was no book errors, but I like to put placeholders for everything. So when we add up the book side, we get $22,200. So the adjusted balance then would be $22,200, or letter E. All right, and then also just as a little review, remember that you also want to study the journal entries for this side, the book side, which would be accounts receivable, bank charge expense, and accounts payable. All right, so in question number 2, we are doing petty cash. So remember that I taught petty cash in a 3-step process. So starting with 1, a refill of cash. So leaving your debits here, but cash gets refilled from the original amount, $250, minus how much cash you have on hand. So in this case, our petty cash fund has $25, so that's going to be a credit to cash of $225. We would debit the receipts. Usually it's for expenses. So that's step 1, step 2, and then you can debit or credit your cash over and short. In this case, we are short $25. So then we can just look for the correct answer. And they are looking for a credit. So the only credit was to cash for $225. All right, moving along to question number 3. This is a cash budget question. So remember, the cash budget is your beginning balance plus receipts, which gives you what you have available. You don't really have to put that subtotal, but minus any expenditures or payments. And I think they call it disbursements. Let me stick with your book. Oops. Gives you how much cash you'll have. So this is excess or deficiency. And then if you need any borrowing to equal your desired ending balance. All right. So using the information we have, we've got a beginning cash balance of $69,000. Cash receipts are $93,000, which gives us, what is that, 9, 10, 11, 12, 162, I believe. Minus disbursements of 117 leaves us with a cash balance of, I believe, $45,000. Okay, So then what we need to do is figure out what is our minimum balance. So our minimum ending balance is $60,000. Now remember, if the excess funds here were higher than our minimum, we would be done, right? We would just carry the $45,000 down to the ending balance. But because the company sets a policy of requiring $60,000, that means we need to go ahead and borrow $15,000, or the correct letter here is B. All right, so number 4 is just a conceptual problem. So there's a lot of internal control concepts that I would just recommend refreshing yourself on. But this one, it's a vocab, right? Only one cashier can have access to the cash drawer. That is the establishment of responsibilities, meaning we're going to assign one drawer per person or responsibility. All right, the next one, the allowance for doubtful accounts. What is that classified as? So remember, the allowance for doubtful accounts is a contra account. So if we had the allowance account, just to do a quick little refresher here, it is married to accounts receivable with the opposite balance. So accounts receivable has a normal debit balance, the allowance account has a normal credit balance, and they are opposite, right? And they are carried together. All right. So that is the contra account to the accounts receivable is the correct answer there. Number 6, the aging of a company's accounts receivable indicates $9,000 is uncollectible. If the allowance for doubtful accounts has a $2,400 credit balance, the adjustment is what? So what they've skipped here is we had accounts receivable balance times whatever percentage equals $9,000. That's how much we estimate is uncollectible. Okay, but our allowance balance, if we looked at our allowance account, has a current balance of $2,400. And what we're saying is that this $9,000 is what we want our ending balance to be. Okay, so in order to figure out how much we need to adjust the account for, because this is a credit balance, we can subtract from our formula here, and we would get $6,600. We need to add $6,600 more to get to our desired balance of $9,000. Okay. So, two things when you're doing this formula, right? This is the adjustment. This is our desired balance. Okay, so there is a question in the exam that asks for the balance. So read very carefully. This question is looking for an adjustment amount. So that adjustment amount would be B. We would debit bad debt expense for $6,600 and credit the allowance account for $6,600. Okay, sorry, I'm a little crumpled up in my notes here. But what I want to remind you again as well is that the allowance account is like a reserve. So we're filling it up at the end of the year, and then when we use it, we're going to debit it. Okay, so this is the estimate, and it's because we don't know how much will officially be written off, and we don't know who. So we estimate it, and we fill up this reserve, the allowance account. All right, and number 7 is a perfect second question here. What do we do when we write off a specific account? Okay, well, we want to credit the accounts receivable, and we debit that reserve. We're going to pull it out of the reserve. So what happens when we do this journal entry? Well, we're decreasing the accounts receivable. So accounts receivable is decreasing, but so is the allowance account. So we're also decreasing the allowance account because we're using it. So the allowance account is a reserve. So we refill it on the right. Okay, so that refill happens on the right, and we use it with a debit. Okay. All right, number 8. This is a hard one. So this is the revision. Remember, there's only one question on the exam, but I thought it was appropriate to review it because I know some of you just really want to get it. So let me walk us through this. So when we have a revised depreciation amount, okay, first we have to figure out what was done in the past. So first we're going to calculate our original depreciation. So $60,000, $12,000 as a salvage, and an estimated life of 8 years. The original depreciation was $6,000 per year. This is the original amount. But now we're going to revise it in year 3. Okay, so 2 years passed. We leave those 2 years alone, and we revise it beginning in year 3. So the revised depreciation entry is going to be your original amount, $60,000, minus accumulated depreciation. What have you already done? Well, we depreciated $6,000 for 1 year and $6,000 for the second year. Okay, so year 1 depreciation, year 2 depreciation. Okay, minus whatever salvage. So I think it says here there's no change in the salvage value. Okay, and then we revised the total years to 5 years, but 2 years already passed. Okay, so when we compute that, year 3, 4, and 5 will be $12,000. Okay, so sometimes I have students that look at this revised depreciation and think of it as $6,000 and $6,000. This is the amount that you've taken out already. So you're kind of reducing what already happened here. So we already recorded 2 years. We already recorded 2 years of depreciation. Okay, another way that sometimes I've seen students write it is $60,000 minus $12,000, and then they come over at the end and write what's already happened, right? Because then it's kind of like the old stuff is together then. Okay. But remember, with revised depreciation, you leave whatever happened in the past, you just take it out. And then in year 3, we move forward with a new depreciation amount. All right, number 9. Let's see, this is a disposal. So equipment cost $144,000, $120 is accumulated depreciation, was disposed of for $36,000 cash. All right, so what I always say is get rid of the equipment at cost, $144, oops, and take off its partner accumulated depreciation. Okay, oops, not 144, I'm sorry, 120. Okay, so both of these come together or come off the books together. They are married, they follow one another. The book value is the difference between these two accounts. So it would be, what is that, $24,000. Okay, so just a side note. Then I would go ahead and plug in cash. So we received $36,000 cash. Okay, and you can figure out the gain or loss 2 different ways here. We can either add up the debits and make sure that our credits equal, right? And so then we would know that we need another credit. Or you can compare cash received versus the book value. We're giving up a book value of $24,000. We're receiving cash of $36,000. Okay, so the difference between those two is a $12,000 gain, I believe. Okay, 12,000. Sorry, I was checking my math there. And it's a gain because we've received more. So if you receive more book or more cash than book value, it's a gain. If cash received was less than book value, it's a loss. Remember, gains are like revenues, so they're on the right. Losses are like expenses, so they're debited. Oops. Sorry, I'm speaking and writing at the same time. Okay. All right, and the last question here is about double declining or declining balance. Sometimes it's also called double declining. So remember, this requires a formula. So it's going to be your book value times 1 over the number of years times 2 equals your depreciation expense. Remember that book value, we can just start with cash in year 1. Or not cash, cost in year 1. Okay, we don't worry about the salvage value till the end. So it's just simply starting with, I'm sorry, why do I keep saying cash? We just simply start with cost. Okay, so 56,000 times 1 over 5 years times 2, which is 40%. Okay, so if we take 56,000 times 40%, we get year 1 depreciation of 22,400. To get year 2, we're going to go ahead and take off depreciation expense, which gives us kind of a running book value, 33,600. Remember, book value is cost minus whatever you've accumulated in your depreciation. Well, right now we've only accumulated one amount, 22,400. So we're going to multiply that again by 1/5 times 2, or 40%, and we get 13,440. Now be very careful. This particular problem says, what is the balance of accumulated depreciation at the end of 2017, the second year? Okay, so they don't want to know the entry amount. They want to know how much depreciation has accumulated. So that's going to be 35,840. Okay, that was a little bit of a tricky one. They're not going to do that to you on the exam, but other questions might, like, what is the balance in the allowance account? So watch your words very carefully and know your formulas and journal entries really well. Okay, there's another exam posted to Blackboard, and of course the SI has additional practice sets. So reach out to me if you have any questions. Otherwise, study, study, study. You guys got this if you put in the work. Thanks and have a great day.